right, live.
What's up, family?
What's going on, y'all? How y'all
Welcome
feeling
back.
tonight? Back in class. We got
Man,
the
listen,
champ. The champ is here.
he is in the building, okay? About to bless us with the financial statements this week.
That's a fact. If y'all don't know what we talking about, we do have David, aka King David, on the stage tonight with us, co-hosting with us tonight. He did win the Bull versus Bear tournament, the one and only Bull versus Bear tournament that we had. So salute to him. He was taking on duos by himself, murdered it. You feel me? And he actually got an invite to the Matrix, and he won a one-on-one with Mark with that. And I think he's gotten a lot more than a one-on-one. So, you know, the work that he put in definitely paid off. But yeah, he's joining us tonight to go over how to read cash flow statements, balance sheets, and income statements. I did notice when he did his Bull versus Bear case, he was really one of the only ones that really went in depth with that, and he made it very palatable. So I politely asked him if he could present to the Cuzzos. If he gave me any, kind of I was gonna motivate him to do it anyways. But David is a good dude. I only had to ask once, and he came
Always
ready.
comes
He said,
through.
"Hey, just let me know when." I let him know when, and here he is. So make sure y'all show him some love tonight. I know he's got a lot of info, so I don't want to waste too much time. AJ, did you have anything for the people before we get into it?
No, I'm excited. Let's get rocking.
Let's
Let's
get
learn about
rocking.
these financial statements.
That's a fact. That's a fact. So if it's y'all first time here, just so y'all know, it's Supplemental Sundays. All we doing is going in detail over some things that did not go over in detail with Mark and Jolynn. So we just covering all the bases. So if y'all do have any questions about some of the basics, or y'all do have things that y'all want to go over, please let us know, because we're going to be doing this every Sunday with new cousins and a new presentation each Sunday. With that being said, David, I'm gonna go ahead and let you rock, bro.
All right, I appreciate it. I just realized, y'all excuse my little typo. I am not the best speller. I spelled financial wrong. I'm just gonna throw it out there for those who already see it.
We family, bro.
I appreciate y'all for having me on. One thing, I was really actually excited when Chico hit me up to ask me to do this, because I really feel like one of the things that helped me during the Bull versus Bear battle was that I can jump between all financial statements and find key points to validate why I was given the Bull case or the Bear case for a certain company. And it really helps just from I guess a competitive or back and forth aspect if you're having to state your claim. But also from me as an investor, it's really easy for me to go in and figure out if I like a company, or when I'm comparing companies to see which one, quote unquote, has a competitive edge. And that's kind of how I think about it whenever I'm going over financial statements. I'm always looking, well, which financial statements gives me an indication that this company has a competitive edge over the other. And kind of the lay of the land here is fundamental analysis. And if you know, fundamental analysis is basically looking at a company's financial statements to see which one has an intrinsic value. Now, once you're able to identify that intrinsic value in the company, that is what's going to help you build out your thesis to see if this company can maintain that competitive edge to give you growth year over year, right? So that's the question you kind of want to be able to answer at the end of going through financial statements. So as many of you should know, because I watched the last week Sundays, right? We have 10Ks, we have 10Qs, and we have 8Ks. And within those within the 10Q and the 10K, we have something called financial statements. There's 3 of them, right? We have income statement, balance sheet, and cash flow statement. All right, so that's just a quick overview and rundown for everybody to make sure we're all on the same page. Okay. So as I said before, there's a quote by Warren Buffett that I love: durability of the competitive edge creates all the wealth. So how well a company can maintain their competitive edge will give them the durability to create that wealth long term. And I do have a question, and you can throw it in the chat. Who has attempted to read a 10K, a 10Q, or 8K since last Sunday? Right? Have we really been putting in the work since we all showed up We all was there to watch it, but have we actually been putting some action behind that? If you haven't, it's okay. If you have, great. I encourage you to do that after today, because we're going to add on top of that. And if I'm correct, each Sunday is probably going to be like math. You're learning addition, multiplication, everything is going to build on top of each other. So if you do take the time, right, to participate during the episodes or do some due diligence after, I'm sure when the next great person comes up, it'll be easy to understand what's being talked about, and you can progress in real time as opposed to having to backtrack. Sometimes it's hard when you're having to go back and watch multiple episodes and then go through and implement it. You can do it in real time. We're all here. So today, that's one thing I'm going to try to do while I'm going through different points. I'll actually be jumping back and forth between financial statements so that we can do some real-time calculations and have some kind of back and forth discourse as best as we can. So I encourage you to get your calculators out, get some paper out, get a pen. You're probably going to want to take notes if you like to, just to keep yourself awake and active throughout this whole presentation. If not, you can always catch the replay, right? That's what it's here for. So as I said before, we got the 3 financial statements, and the first one we're going to jump into is income statement. Income statement, in my opinion, is one of the most important. So when I go through all 3, I always start income statement, I go to balance sheet, then I go to cash flow. I do that for a level of importance because most of my meat and potatoes I'm going to get in income statement. Then what I need after that, I'll find in the balance sheet. And I'm looking to the cash flow statement kind of last to validate what I looked at the other 2. And you'll kind of see why I see it through that lens as we go through the different key points that I believe you should hit on when going through financial statements. So with that said, there's another point that I want to make. There's 2 ways you can kind of go through financial statements. All right, and I'm gonna can stop sharing this presentation because I'm going to show you. You can go through a traditional 10K or 10Q where you go through the consolidated statements of operations. Just a big word for income statement. Fun fact, if you ever see consolidated statement of operations, just a huge word for income statement. Don't get confused. They often have this lingo in here that makes it kind of confusing, but they both mean the same thing. Or you can do what I do is you can go to Seeking Alpha, and where it says summary, go to where it says financials, and then boom, you got all the same information. And the cool part that I like is if you have the free version or the paid version, you can see multiple years. If you actually go through a 10K, they only give you the last 2. If you go through a 10Q, they only give you the last 2 quarters. So one of the things that I like, just so I can have a little more information to see a longer time frame horizon, is go to Seeking Alpha to see multiple years or multiple quarters. So that's one thing I like to do because it's quick, it's easier to do, and also it's just is more visually pleasing on the eyes. And I think that's really important when you're going through financial statements, to keep it easy on the eyes so that you can really go through the numbers and kind of create a narrative and story. All right, so that's one little tip I want to give you that I feel like goes a long way. So here are the 5 things that we want to make sure we hit on when we're talking about income statement. The first thing is we want gross profit margins to increase year over year. Now, you probably hear people say their margins increased, right? Their margins, when you hear someone say gross profit margins or their margins, again, the same thing. Someone says, oh, the margins are increasing. Someone says, oh, the gross profit margins are increasing. They're saying the same thing. All they're referring to is the percentage of net sales that has increased, okay? And there's a calculation you actually have to do to get gross profit margin, right? That's not something that you can find on the income statement. So as I said, I'm gonna be jumping back and forth. So if we actually go to an income statement, I'm using AMD as an example, right? I don't know about y'all, but AMD's been good to me this year. Shout out to the people who've been in the option contracts for AMD. So you have revenue, and then you have cost of revenue. And then you subtract those 2, that gives you your gross profit. So for example, if I create t-shirts and I spend $100 on those t-shirts and I make $500 profit, my gross profit is $400 because I got to take out the cost of the revenue, right? The $100 that I put in from the profit I actually made, which is $500. So that gives me my gross profit. Now, what's the percent change of that, right? That's what we consider the margins or gross profit margin. So easy calculation to do that. All you would do is take gross profit and divide it by total revenue. And then once you do that extra step, you will times by 100. and then that will equal the percentage. So I'm going to put that last tidbit in there. So again, you'll take gross profit divided by total revenue times by 100. It will give you a percentage. And then from there, what I typically do is I'll look at the last 3 years for a company to see if gross profit margins have been increasing or if their margins have been increasing. Again, I want to teach you the lingo so that when you're talking, you hear people say different things, you understand what they're talking about. So do AMD, right? Quick calculation. We're going to do quickly. We're going to do AMD for 2018, 2019, 2020. I'm going to do it. You guys put in the chat what you get. Let's see if we get the same thing. So again, you're going to do gross profit divided by total revenue. So we do the first one. I'm pulling out my calculator just like y'all should. I'm doing it in real time. All right. So you see how easy this is. So 2 divided by. So in 2018, you should have got 42%, 42.6% was their gross profit margin in 2018. Okay. So someone do 2019 for me, throw it in the chat. I'm gonna do 2020. All right, so let's see if they're increasing over the last 3 years. All right, 44.5% is what I got for December 2020. All right, so I can tell you from 2018 to 2020, they did increase, right? That is a positive sign. Those are the kind of things you want to see in the company. Now, if you look at it, so this is what you can do on your own time. Go look up Intel for the last 3 years. I think you'll find something interesting. All right, and again, this is what you would do from a strategic standpoint when you're comparing companies. One simple metric that goes a long way. Has their net sales percentage-wise been increasing year over year? If they have, positive, good. If not, red flag, right? Red flag. So that's one way you can look at a company and simply make a decision. So that is gross profit margin increasing year over year. Next thing you want to do is you want to see that gross profit is 30% or more of total revenue, okay? Now, the question becomes, why is that important? Because if you have anything over 20% of gross profit from total revenue, then that means that your cost of revenue isn't eating away from your revenue or your total, your gross profit. I'll say that one more time. If you have gross profit of 30% or more of total revenue, that lets you know that your cost of revenue, what you're paying for your inventory or whatever, is not eating away from your gross profit. So if you wanted to do a calculation for that, all you would do is you would take 30% of total revenue and compare that to gross profit. So let's do that in real time again. So again, gross profit, 30% or more of total revenue. So take total revenue. So we do 2020 for December, total revenue. We're going to take this number and times by 0.30. That will give us 30% of that number. So if we do 9763 and times by 0.30, right, you should have 2,928. That's actually 2.9 million. Remember, this is in millions, fun fact. Okay. And if we look at gross profit, we see that gross profit is more than 30% of total revenue. That is a positive sign. It is a positive sign that this number is higher than the 30% that we calculated from total revenue. That is something you want to see, because again, that lets you know that what the company, their cost of revenue, what they're paying to make their money isn't costing too much, right? They're not overpaying for their inventory or their service, right? Because it could be a product or service, and it's not eating away at their profit margins, right? And those are the kind of things you want to look at and see in the company, because very telling long term. For example, I don't want to be paying $200 for shirts just to make a profit of $150, right? It's kind of counterproductive, right? In the business, eventually our goal is to make money. All right. The next thing we want to see, and this is, and I'm going to allow you to do the calculation on your own, but I'll tell you why this is important. We want to see steady, or increasing SGA. Now, some people will say, well, hey, David, SGA is technically an expense for a company. Why would SGA want to be steady or increasing? Okay, well, we can look at it a couple ways. So if we use AMD, for example, we see that AMD, their SGA has been increasing. If we go the last 3 years, it has been increasing. Now, why is that important? Well, for a couple of reasons, let me define what SGA is for you. SGA is Sales, General, and Admin. What the heck does that mean? That is what a company pays for payroll, for travel, for marketing, for legal fees, to keep it very simple for you. So if that's what SGA is for a company, you would not want that to be low, because guess what? All it would take for somebody to do is pay better money, have better marketing to do what you do better, right? Scared money doesn't make money. So if I have a business, and let's say TiVo, for example, I have a business, and I spend more money doing marketing, and guess what? I find the best people, I'm not willing to pay them. I'm probably going to get the best productivity out of them. I'm also going to have the best outreach. Thus, I have a better chance of yielding more profit than he would from a business standpoint. That is why you don't want to see a company's SGA decreasing dramatically, right? Because again, that lets you know that they're not actually putting money into the company necessary to maintain whatever competitive edge they may have. And again, that goes back to my original statement. We want to be able to identify if a company has a competitive edge. Same thing for research and development. We want to see research and development being steady or increasing, especially if you're a tech company. I'm sure many of us love tech. All right, we're talking about AMD, for example. We're talking about Apple, Microsoft, Tesla, Amazon. These companies, in order to stay competitive, have to innovate. So we will not want to see that decrease dramatically. And again, we will not want to see that increase dramatically either, because if so, then we'll have expenses that are eating away into our operating income. Okay, so now what I want to do is, before we go into some number crunching, I want to make sure we're able to understand and identify what all these terms mean here on the income statement. So again, income statement is only revenue and expenses. That is it. So here at the top part, we have revenue. And that's broken up into two categories: revenue, cost of revenue, and gross profit. Then from expenses, the main expenses you're ever going to see for a company are SGA and R&D. And guess what? Some companies, you won't see R&D. For example, Coca-Cola, they don't got no R&D. They're not changing the Coca-Cola formula. They're not changing that up. So certain companies, they don't have R&D. You'll be surprised. But especially the industry, right? Tech does. That's one of the industries where we definitely will see that. Okay. And if we add those two things together, we have what? Total operating expenses. That's self-explanatory. Now, here's the kicker. If you take gross profit and subtract total operating expenses, that's what we have here at the bottom, which is operating income. How much income was made from operations? So we've done a few things here. We've been able to have to calculate gross profit margin. Being able to make a story out of SGA and R&D. You see them going up or you see them going down, it tells you something. So you always want to try to create a narrative of a story about the numbers. Never take the numbers to be black and white, because if you do that, you actually put yourself in the corner and you really don't understand what's going on, which is why I'm kind of trying to phrase things how I'm phrasing them, while saying, well, hey, if this has this could potentially mean this, right? So again, if we see a company has decreasing SGA and R&D, that lets us know that either mentally they're not willing to invest in the company to maintain great employees or great technology or great services, right? That tells you something, especially if you're having to compare, right? And then we're also going to see that reflect the company in terms of their operating income. So those were the first four big things that we wanted to look at. 1, 2, 3, 4. Gross profit. Gross profit margins. Gross profit being 30% more total revenue. And then again, we want to see SGA or anything lower than 30% of operating income. If you want to do this calculation, all you would do is take operating income times by 0.30, take 30%, and compare that to SGA. Let's do that together too to make sure we're all on the same page. So we're going to take operating income for AMD. We can do the most recent year. We're going to times this number by 30% and compare it to SGA. So 1369 times 0.30. That is 410. So we see that SGA, so we compare that to SGA. We have SGA is more than this number. So again, it technically should be lower than 30% operating income. So that's something to take into consideration. that technically their SGA is high if we're taking 30% of their operating income. That's not a bad thing. Again, we want to see companies invest in their company. It's not a bad thing. It's just something to keep an eye on and have an understanding of. So the last thing we're going to do is interest expense. So we want to see interest expense or interest payouts lower than 15% of operating income. Okay, so why is that important? It's important because for a couple of reasons. Let me explain what interest expense or interest payout is. I want you to think about it as what is the debt you owe on your credit card. So if you have a credit card and you owe, I don't know, $1,000 on that credit card, right? Maybe your payments are $25 a month. For a company, they have something similar. They have an interest payout and they have to pay that out. Okay, so if a company interest payout is too high, it can mean two things. It can mean that they're a company that has a lot of CapEx spending in a competitive industry, or they're a company that has acquired debt from an acquisition. But what do you mean by that, David? Microsoft, for example, just acquired a company called Nuance. Okay, because they acquired that company Nuance, typically what happens in an acquisition is they will also take on the debt that that company owns. If they take on the debt for that company owns, when we look at Microsoft's income statement for next year, it's probably going to be higher, right? And that's okay because all they did is acquire a company to vertically integrate into their own. But we still want to see that their interest payouts are lower than 15% of operating income. That's a very important metric because we want to make sure that what they're paying out on that credit card, quote unquote, isn't eating away from their operating income too much. Again, operating income is how much money you make from your operation. So let's do a quick calculation once again. Let's do a calculation once again. So we go to AMD, we go to interest expense here. Again, interest expense is what they're technically what I call quote unquote paying on their credit card. It is a negative number because they're paying that out. That makes sense. So we go to December 2022. All right. So we'll take 15% of operating income. So here. So we take 15% of 1369. 1369 times 0.15. We have 205. Interest expense is 47. So their interest expense is lower than 30% of their operating income. That is a positive sign. Again, we want to see that this number is lower than 15% of this. Don't think of this as negative. Remember, it's only negative because they're paying that out. So think of it in nominal numbers. So think of this as 47, not negative 47. So 205 is more than 47. So that would be a good thing if we were to check that off on our quote unquote list of things we want to see for a company for their income statement. So those are the 5 things I look at on income statement. I look at nothing else because those tell me everything I need to know for the most part for a company if they have a competitive edge that can be maintained from a financial aspect. And again, we're looking for a competitive edge in terms of their finances. We're not talking about, oh, well, Apple has everyone in their ecosystem, right? We know that's a moat or competitive advantage that Apple has, but can we see that in the numbers, right? Can we see some type of competitive advantage in the numbers? And that's kind of what you're doing. And I do encourage you to do this and practice it because this is actually, I'm keeping it real. If someone told me this, I didn't realize it. When we do this as investors, we're kind of doing accounting. If you know accounting, like this is actually accounting what you're doing because you're going over numbers and understanding how the numbers correlate to a business. So again, this is not meant to be easy. I'm doing my best to keep it, as Tebow would say, palatable, right? But this is somewhat difficult. So for those who are learning this, I want to say, I applaud you. And I say, thank you for having the courage to sit through this, right? And learn this, because this is the unsexy part of investing. I'm gonna keep it real with you. TA is more fun, right? Figuring out your how much your premiums are gonna go up is more fun. This is not the sexy part of investing, but it is what separates the good from the great. It is what separates the okay to the better. It is what separates the 1 contract game from the 2 contract game, right? It's those little things. So this can go a long way. I'm saying all that to say this can go a long way. All right. So the next thing we're going to go into is the balance sheet. Balance sheet is cool because this is even more simpler to understand, I think, than the income statement, which is why I put it on the second tier of priority. because it's not as robust. So balance sheet lets us know about assets, liabilities, and shareholders' equity. Okay, those are the 3 things we get from a balance sheet. So there's a couple of things I want to give you on the balance sheet. When we look at a balance sheet, and I'll actually go to one now. I go to AMD's balance sheet, for example. First thing we're going to see is cash and cash equivalents. And then we're going to see accounts receivables. And then we're going to see current assets. Then we're going to see long-term assets. Then we're going to see current liabilities and long-term liabilities. Then we're going to have common equity. Well, let me break this up and give you an understanding of what each of these are. First thing I want to jump into is accounts receivables. Okay? I'm going to tell you the cash flow of money in a business. Business has cash. With that cash, they buy inventory or they produce a service, either or. From there, that business with that product or service sells it. And when they sell it, they either get money directly or they get something called account receivables. Account receivables like net 30 accounts or net 150s, which basically means 30 days, 150 days, hey, you should have saw bread. And that's really cool because it allows you to make projections on when you have money coming in, right? On a 30-day, 150-day basis. So that's what account receivables are. So if you see this number increasing, that's a good thing because that means a company got bread coming in a couple of days or a couple months. So that's a cool thing, right? And then from those accounts receivables, right, you get the cash again, and then the cycle starts again. With that more cash you have, you do more inventory or produce a bigger service. And that's the cash flow cycle in a company. So that's what accounts receivable are. Current liabilities, you have current liabilities, and then as I say, other liabilities or long-term, current assets or long-term assets or other assets. Current assets are assets that can be liquefied or liquidated within a year, which means you can get your money quick for it. For example, if I have a phone company and I got all these chips from TSM that made them, well, guess what? I can sell that pretty quickly and get my bread for it. That is a current asset because it can be liquidated really quickly. Now, this factory I got over in Idaho in BFE that nobody knows where it is, it's gonna take me a little bit more time to sell that. That will be another asset or a long-term asset. It's gonna take me more than a year probably to sell that or liquefy it to get money for it. Same thing for liabilities. Current liabilities are liabilities that can be paid off in a year. Other or long-term liabilities are liabilities that take more than a year to get paid off. So boom, that's a simple way of looking at a balance sheet. And then if you take assets and liabilities, you have shareholders' equity. And remember, a company's #1 job is to give value to shareholders. Remember that. That's the #1 job of a company, to give value to shareholders. And with that said, I'm actually going to jump into another point. The main 2 ways that a company adds value to shareholders are 2 ways: buying back shares, paying a dividend. Those are 2 ways a company could give equity back to shareholders. Because when you buy back shares, right, it's the opposite of diluting shares, right? You're buying more shares back, so it adds value to the shares that you own. You're paying a dividend, you're going to incentivize someone to keep their shares. But what happens is you want to find a company that does both. Some companies don't do both. Like Tesla, for example, doesn't pay a dividend, right? But what they try to do is they try to put money back into the company, either by buying back shares or just actually expanding in the company via research and development, SGA, so forth and so on, okay? So when we're looking at a balance sheet, here are the 5 things, 5 things that we want to look at. First thing we want to see is that inventory and net income have a rising correlation. Next thing we want to see is, hey, there's more current assets than more current liabilities. That's an easy one. We can all understand that. Then there's something I like to do, again, calculations. I never take numbers at face value. The 2 calculations I love to do is debt to equity ratio, return on asset. So debt to equity ratio tells us how leveraged the company is. Are they working off debt? Or are they working off of bread they actually have? Return on assets, easiest. How well a company is generating profits from assets. Those are 2 important things you want to see a company do. And then treasury stock lets you know if a company's actually buying back shares. Now, I know what most people do is they look at total outstanding shares to see if shares are being, they're creating more shares, if they're diluting shares, right? We typically look at total outstanding shares to see if that number is increasing. If it is, that lets us know that, hey, they're diluting shares. No bueno. But I like to look at, I think of as a default that everyone looks at that. So the extra one I throw in is looking at treasury stock. The reason that is because you can get finessed by companies. Well, what do you mean by that, David? The way you can get finessed by companies is if they are diluting shares and then buying back shares, they're just eating off of shareholders. And you would never know because you're either looking at one of them, total outstanding shares or treasury stock, right? When you should be looking at both. Because if you see that outstanding shares is staying steady, but treasury stock spending is going up, that lets you know a company is actually trying to add value to shareholders and they're investing back into the company. But if you see a company's outstanding shares increasing and treasury stock increasing, you're getting finesse because they're just buying back the same shares they put out. It makes no sense. It gives a false illusion. It can create a false narrative in the mind of those who may be a little too lazy to do a little extra digging. So with this gem, right, I'm gonna save you a little bit of time so you don't have to make that small mistake. So let's start back from the top. Why is it important that we have inventory and net income have a rising correlation? Very simple. It lets you know if a company can meet demand. Right? If a company's inventory is increasing, but their net income isn't increasing, that's not a good thing. That means they have all this inventory that's sitting that they're not making money off of. Okay? So I'm gonna take my attention off of AMD and we're gonna go to another company, by the name of Intel, because if you look at their inventory and net income, you may find something interesting that lets you know why AMD has a competitive edge over Intel. Again, you want the numbers to show you, right? We hear it, but can you prove it through the numbers? I think that's cool, right? Because it validates your thesis even more. Why am I saying all this? Because this is exactly what you can do when you're comparing two companies. It's that simple. I know it really is. So let's go to the balance sheet. Oh yeah, let's also go over the definition of net income. Fun fact, a lot of people don't understand that. Let's start from the top. Gross profit is revenue minus cost of revenue. Check. Operating income is gross profit minus total expenses. Check. Net income is total revenue minus cost of revenue, total operating expenses, and taxes. That's net income. That's net income. So net income is the number that you really care about. All right. So here's Intel. If we go to their net income, we look at their net income has decreased. Let's just start the last 3 years. 2018 to 2020 has decreased. Okay. Well, actually, 16 to 17 decreased too. Golly. They're making my point even easier. As you can see, this number has decreased, their net income. Go to the balance sheet, look at the inventory. Look at that, steady increasing. But why is that important? Because we have the proof in the pudding here that this is a company that cannot meet demand, or they don't have any demand, actually. That's why they have all this inventory sitting around and their net income has been decreasing. Let's juxtapose it to AMD. AMD, we go to their net income. Their net income has increased. They were negative for many, many years. 2018 to now, positive. Let's go quarter over quarter, right? If you really want to get into the nicks and crevices. Significant increases. Now, let's go to the balance sheet and look at inventory. I'll give it to you right now. Inventory has been increasing. Inventory increasing. Very positive. Now, this is where you want to be scared if you saw AMD's inventory start to fall and their net income rising, because now that means that they don't have the supply to meet the demand. That's not a good thing if a company has all this cachet and everyone wants to buy their products or services, but they don't have it. That's not good. And people are going to get dissatisfied because what you're going to have things coming in late, so forth and so on. So again, this is another metric you can use. Inventory and net income have a rising correlation. A classic tale for a product company has a competitive edge. One of my favorite metrics to look at. And it's very easy to see. Not much calculations you have to do. Again, total current assets over current liabilities. That's self-explanatory. Which one? If the assets are bigger than liabilities, that means that the company has enough power that things went left that they can cover all expenses that they have. Right? That's kind of important. You want to see. Just how if you're dating somebody, you want to make sure that things go left. Well, hey, you got what it takes to hold things down until we get back to where we need to be. Just how it works. Okay. Now this is where the calculations come in. Debt to equity ratio. This lets you know how leveraged, again, a company is. Easy calculation. Total liabilities divided by total shareholders' equity. And then you will times by 100 and it'll give you the percentage. So let's go through one example. We're going to go through AMD. So we have to take total liabilities divided by total shareholders' equity. So total current liabilities. Let's do the most current year. Total current liabilities. So 2417. Again, get your calculators. I'm doing this with real time with you guys. 2417 divided by total shareholders' equity. Right here, total shareholders' equity. So 5837. Boom, times 100. She got 41.4%. 41.4%. Now, this is something very important. You would never look at this number by itself. You would never look at this number by itself. You will always have to compare it to another company. So if you wanted to see if this number meant anything, you would have to compare it to Intel. And then that would tell you something. The number itself, any ratio, debt to equity ratio, return on asset, return on what's the other one? Return on asset, return on equity. All these ratios mean nothing unless you compare them to another company. The number by itself gives you nothing. It's just a number. So you will have to compare debt to equity or return on asset. You have to compare that number to its competitor to see if it makes sense, or those in its industry. So you can compare this to Marvell, to Intel, to Qualcomm, something like that. If you're doing suppliers, Applied Materials and Micron, right? You compare those two, right? You want to make sure you're comparing it to a company in this industry, because that will let you know if it makes sense, right? In terms of debt to equity. For example, you want the company that has the lowest debt to equity ratio. You want the company that has the highest return on asset, because it lets you know that this company is producing money from its assets, return on assets, or this company is not over leveraged, or it doesn't have too much debt that's acquiring debt to equity. Number 5, the last thing is treasury stock. So this one is very easy. Treasury stock, you go to the balance sheet, you just go down to the bottom, has it right here, treasury stock. And if you look at treasury stock for AMD, this number has been increasing. They've been consistently buying back shares. This is a positive sign. Again, this number is negative because they're having to pay to buy back those shares, which is why it shows negative. Just giving you context. Okay. I don't know what Intel looks like, but we're going to just check to see. They could be buying back shares. I don't know. I'm curious to see, actually. I don't invest in Intel, so I don't know their business like that. So if I go to, awkward. They don't even have it on here. Well, I guess that says everything I need to know. They don't have treasury stock on here for Intel. Okay, so another lesson. If you can't find it, this is where you would want to go to the actual report and find it. So again, remember I told you use Seeking Alpha to be user-friendly and you get more information. Well, if there's something you feel like you didn't get here, you can always go back to Old Faithful, the 10K, 10Q. Shout out to my boy who did the presentation last Sunday, right? And you can find this information right here. Okay, again, it's very important that we're making sure we're paying attention to everyone's coming up, because all this information is cumulative, adding on top of each other. So actually, let's go to 10K because it'll show easier in the 10K. So we go to the 10K. Again, that's the annual report. 10K comes out once a year. There's 3 10Qs in a year. Where's the 10K? There it is. Sorry. So 10K is here. You go to 10K, you would go to financial statements, which I believe is item. Oh, see, this is why Intel's trash. They don't even have the table of contents on here. They don't even have it linked on here. This is why you should invest in Intel. I'm just gonna tell you that offer up right now. They don't have the table of contents linked, so they make you scroll through it. That's just, I already don't like this, y'all. I'm gonna keep it real with you. I'm never gonna front because now this makes it even harder for me to find this information. Okay, here we go. Boom. Thank God I go through this quick. Common stock. Repurchase activity showing the following. Yeah, they haven't been buying back any shares, y'all. They haven't bought back any shares. Yep. Total number of shares purchased. Y'all see it has a blank here. Boom, boom, boom. That explains why when I went on Seeking Alpha, it doesn't show. So there it is. Double confirmation. Double confirmation. They're not buying back shares. That says a lot. But they do pay a dividend. So, hey, they're doing one of the 2 ways to add value to shareholders. All right. I'm not going to go too deep into it, but for those listening, look to see if their total outstanding shares is increasing. If it is, that lets you know they're diluting shares. And if they're not buying back shares, they're actually now taking value away from shareholders. Remember, the number 1 job of a company is to add value to shareholders. There's a lot of ways you can cut and slice these financial statements to find things you want to find and to give you reasons to invest in the company or to not give you reasons. And I hope I'm doing a good job of showing you reasons to invest and reasons not to invest, because the one right here with Intel not buying back shares, that is not a reason to not invest, but it's a red flag. Again, I don't want to be too biased. I'm trying to give you indications of red flags you can see. That's definitely one of them. Now, last thing we're going to go into is cash flow statements. Cash flow statement summarizes the amount of cash and cash equivalents entering and leaving a company. Okay, this is the last thing that I look up when I'm looking up a company. Sometimes, to be real, 100% transparency, I don't even go to the cash flow statement because I usually have my mind made up after the first 2. But there are instances where I need to go to the cash flow to be my deciding factor. The reason that is because in actuality, the cash flow statement is actually like a combination of the balance sheet and income statement. So that's another reason why I go to it last on my list, because actually a combination of the 2. So the first 2 should have actually gave me all the info I needed. Again, I use the cash flow as like a triple confirmation if need be. And when I do, I keep it simple. I'm gonna look at 3 things, okay? So let me break down what a cash flow statement looks like. So we go to, let's stay on Intel since we're already here. It's broken down into 3 things: cash flow from operations, cash flow from investing, and then cash flow from financing. Those are the 3 main things that make up a cash flow statement. Okay, cash flow from operations is the amount of money the company makes from its operation. So if I have a t-shirt company, how much money I make from selling t-shirts, that's what's going to be my cash flow from operations. My cash flow from investments is the cash inflow and outflow from investing in assets such as property, equipment, or collection on a loan issued, right? So those are cash flow from investments. Cash flow from financing is the outflow of cash from paying out a dividend. Again, that's one of the ways a company adds value to shareholders, okay? Or selling stock to finance a new plant, okay? So that's what I'll see from cash flow from financing. So the 3 things I want to see, or the main things I want to look up to keep it very brief, is I want to see that cash flow from operations is positive. I want to actually know that from what I do in my core, I'm actually positively making money from it. So you want to see that be positive, and you also want to see that increase. So if we look at cash flow from operations, hey, shout out to Intel is actually increasing. Finally do something right. My bad, I'm not supposed to be biased. Now we go to AMD, cash flow from operations. They're increasing as well, okay? So that's a positive sign, okay? One of the companies that I did on the bull versus bear was NNDM. Nano Dimension. Let's look at their cash flow from operations. They are negative, red flag. CRISPR. I'm sure we've heard of CRISPR Genomics. CRSP. We look at their cash flow from operations. Negative, right? The fact that they were positive in 2019 went negative, right? That tells you something. Also think about the industry they're in, give it context, right? A lot of companies that are in genomics aren't profitable. They work off grants. It's something you have to know and understand going into a company, okay? But that's where you would look up that number, and that's what that number means. So those are reasons to invest and reasons not to invest, and red flags you can potentially see. Next thing we want to see is that cash flow from investments, right? If you see cash flow from investments is greater than cash flow from operations, that is not a good thing. That is a huge red flag. The reason is because that lets you know that the business is living off of buybacks and bonds. You're getting finessed. If the cash flow from investments is greater than the cash flow from operations, that means that the company is living off investors through buybacks and bonds and selling bonds. That is not a good thing. Okay, so simply you will look up the company, you will look up cash flow from investments. Let's just go back to Intel. We'll look up cash flow from investments and compare that number to cash flow from operations. So cash flow from investments, let's go say 20, and then cash flow from operations. So cash flow from operations is more, right? Again, this number will be negative because remember, this investments, they're paying this money out. Cash flow from investments, that number will be negative because they're paying that money out. Again, same thing with treasury stock. That lets you know if a company's buying back shares, companies buying back shares, they're paying that money out. Therefore, that number will show up negative. So I'm gonna give you context again on how you should be looking at these numbers and reading them. And then the last thing is steady or increasing free cash flow. That is important because if things go left, you want to know that a company has the cash flow to hold things down. Right, Apple, we rave over Apple because we know if Apple needs to acquire anything, they need to make anything, they have the cachet, they have the rapport, they have the experience to do it. So that's really important things we want to see when it comes to a company. So that's the last thing I look up when I'm looking through a cash flow statement. Again, the cheat code you can use instead of looking up the 10K, 10Qs, just to keep it easier on the eyes and do your calculations and get a longer time frame horizon, is to go to Seeking Alpha. They have a free version and a paid version. Use the free version. Or like my man showed y'all last week, go to the 10K or the 10Q. All the information is there too, right? They only just give you 2 years or 2 quarters. That's the only difference. All right. And then the last gem I'm going to give you guys is Fisher's 15 points for investors. It's literally just 15 questions that every company should be able to answer if they're quote unquote good. I use this too. This is actually this is actually a hidden gem. I'm gonna help y'all because these 15 points or questions you want to ask about a company, they're really good. And the reason why I'm putting it here is because they're non-numbers related, right? So it actually is actually going to force you to do a little bit more digging in that 10K or that 10Q, because the 10K gives you a lot of information. So this is another gem I'm going to give you guys, and I encourage you to use it. I actually go here first with the 15 points, and then I go to my financial statements. But there's another gem for you guys to look up. That's all I got. I hope that was very helpful. Give you guys some gems on how you can go through all of this. I love showing people how I go through financial statement because I really believe that there's a cheat code to go through it because it's really a hefty document, a 10K or a 10Q. And let's keep it real. A lot of us don't have time to go through a 60-page document to read and then comprehend and then dissect and then try to create a thesis out of it. There is a cheat code to doing it. And that's what we're learning through these sector Sundays right now, or these financial Sundays, right, as we can call them. We're learning these quick tips, these gems on how we can swift through information a lot quicker and more concise. Because if you notice, I didn't go into the meat and details of the cash from operations. Yeah, it's not important that I know all those little things. There's a couple key things that need to be hit on, and that's it. And you really don't have to make it more complicated than that. It saves you time. You get all the information you need. And if anything, you have numbers that can validate a thesis as opposed to, I feel this, I saw this, I heard this. Kramer said this, right? Or if you hear some great things, Mark said this. Well, hey, I can find a metric, an objective metric to validate it, as opposed to a subjective metric, which is like a feeling or something you heard, or news, because that can change. Numbers don't lie, right? So the easier you can do this, the better your life will be, and the more confident you'll be in your investment. So y'all can stop hitting on my boy Tebow, ask him how you feel about this, that, and the third. I got no excuses now. Y'all can figure out yourselves. But that's all I got. I appreciate everybody for being on here. I hope you guys are able to gain a little something. And a fun fact, these metrics are everything I did during the bull versus bear battle. I just picked which ones I want to talk about for each one. So it was really easy for me because, again, you can find what works and doesn't work. And the company tell on itself. Like the bull versus bear were really easy for me, full transparency, because I just looked at these metrics and they either were good or bad. And if I was on the bear end, I took the bad ones and ran with it. If I was on the bull end, I took the good ones and I ran with it. And I just expounded on it. Again, you don't have to make it complicated. It's really that simple. Just learn how to create a narrative out of the numbers. If you remember anything tonight, remember, create a narrative out of the numbers, because that really shows you understand what you're doing and you know why you're investing.
Appreciate that, bro. Felt like a little course. Felt like we've been going through a course on Supplemental Sundays.
It was.
Listen. If y'all if y'all didn't catch some gems on the checklist, right? What was the last one he gave us? The Philip Fisher's 15 points. I encourage y'all to go look that up. But just like we practiced while he was going through his presentation, you need to do the same thing for homework. Because that's just the repetition. It's the repetition that makes it easier each time.
And like he said, it's not the sexy part of investing, but it is investing. If you're just doing technicals, you slick gambling for real. Like technicals only tell so much of the story that you're putting your money into a business, and you really should know how that business operates, why it operates as such. Especially if you're buying leaps, the numbers is going to tell you where that company is going 99% of the time. Now there's going to be Corona, there's going to be sometimes things that happen that can change the face of a business. But if you are able to break down these numbers and, like he said, create a narrative using those numbers, whether they're increasing, decreasing, sporadic, you'll be able to see where the company is going based off their trajectory in the numbers, just like you can see the technicals where the company is going, in the trajectory that they're in. So we definitely appreciate you, David. That was a very, very clean cut. Like AJ said, that was a course. Like people would pay for that. So we appreciate you. We value just the time and the energy that you put into that presentation. And this is a guide. So just like the last video, whatever company you like or whatever company you're thinking about buying a leap on, go ahead and play this back, pause it, do your notes, go have your financial statements pulled up so that you can break down that company that you're looking at and really get it yourself. Because again, like we said last week, it's one thing to be able to watch the teacher do 35 times 78 on the board, but if she give you a worksheet with totally different numbers, can you do it yourself? It's going to take time. It's going to take practice, but it's going to help you. And then when you do see deals or you do see stocks fall like Square or PayPal or Visa or, some of these stocks that we love, Amazon, you'll know whether it's actually a good company to buy at this point, or if it was just a dying business in the first place and it's going to lay 6 feet. You feel me? But thank you again, David. Make sure y'all show him some love. If y'all got any questions or y'all got anything y'all want to go over in the future, make sure you type it into the comments. I do look at the comments. I did want to put out there, I have a lot of men coming up on the schedule. I'm all about the ladies. You feel me? Not like that I'm married, but you feel I like to keep the ladies involved too, because y'all are very wise. Y'all have a lot of, chill out, AJ. Y'all have a lot of knowledge. Look, let it slide, let it pass. We gonna, but you know, y'all got a lot of knowledge too. And I know y'all got a lot to bring to the table. Sometimes the stage can be intimidating, but it's all love. It's all love. And I'm gonna help you as much as I can. You know, you can't have a partner. These two gentlemen did it solo, but you can have a partner to do this. So if you have something that you feel you want to bring to the table and to present to the cousins, please hit me. Hit my DMs, comment under the video, say it in the Facebook, because we gonna keep this going. You feel me? We gonna keep this going. We gonna make them courses have to really earn their keep. You know, because we trying to get this channel built out to where, oh, you got a question about this? Go watch this video. Oh, you don't know how to do that? Here's a link to that. And because you know the come up gets kind of mixed in because Mark and Jolene produce so much content and talk about so much in one episode. Even me doing the timestamps, it's hard sometimes to find that 1 5-minute clip in an hour of 100 hours of videos, you know, where if we have a set video to break down every single concept of investing, what better place to come, you feel me, than the come up series.
Free 99 too.
Free 99 and easy to listen to, because I know you all of this information is on YouTube, but you might get on there and it's, hey guys, what's up? We're gonna go over. I'm not trying to hear all that.
Straight to the point. Give me the gems.
I don't know about y'all, but I can't do the extra clapping and you know the edits and all. I can't do all of that. I like a simple, calm, smooth, you know, give it to me straight and let's get off the video. You feel me? Yeah. I don't want to link to your other video. I don't want none of that. But that's the type of thing we trying to build out. AJ, did you have something you wanted to share with the people before we get
Yes. So before we get up out of here, y'all, it's about to be a volatile week. So we need y'all to be careful. We need y'all to keep y'all's head on a swivel, be looking left, right, all of that. So a couple things coming up this week we can discuss real quick. We got earnings, a couple of earnings that I'm looking at. We have Lennar on Wednesday, right? So if y'all don't follow the real estate space, that's a good one to be following. We also on Thursday have Rivian. Okay, Rivian earnings, Adobe, and FedEx. So these are some earnings that I'm personally looking at this week and we'll be following. From an economic standpoint, on Tuesday, we got the producer price index, all right? So for those who don't understand, that's how you gauge, you know, inflation. Basically, it measures the cost from, you know, very like an industry standpoint, right? Not a consumer standpoint like CPI. And then we also have the FMOC, right, on Wednesday, okay? So they're supposed to be talking about federal interest rates, y'all. So that could be an extremely volatile day. If you have your plan, you have your limit order set, you might be able to sneak in there. So just make sure you're doing your due diligence and preparing for this week. Thursday, we got initial jobless claims. So that's basically just reporting how many people have filed unemployment, right? Who need unemployment insurance or benefits. And then most importantly, y'all, Friday, well, I'm not gonna say most importantly, but also Friday, don't forget, it's Quad Witch. So we got contracts expiring. So like I said, it's a lot going on this week. Consumer sentiment is something we definitely want to be paying attention to as the Fed talks about interest rates and we see inflation and everything being talked about. So these are some of the key things that we want to make sure that are on y'all's radar going into next week to keep the family safe.
Appreciate that. Yeah, so now y'all know what to look for. You know, keep your head on the swivel. It's the end of the year, so it's a lot of tax loss harvesting. So people are selling off their positions, you know, locking in some of them tax losses. It's been very volatile. Where you might have a 90-day low and a 90-day high all in a matter of 2 weeks. You know, so just keep your eyes open. Do not over leverage yourself. I know it can be rewarding, but you can blow your account in a matter of 10 minutes on one position, you know? Exactly. So, yeah. But David, did you have anything else for the people?
No, just keep grinding. A lot of people ask me how long it took me to get here. It took a while, took a lot of reading, but I was patient with myself. So I just encourage you to be patient with yourself and keep showing up. You know, the content's here, the people's here to support you. So it's all love.
This is facts. And yeah, like he said, everybody starts somewhere, man. We didn't get accounting degrees. We didn't get, we didn't go to these investment schools and different courses, and our daddies wasn't hedge fund managers, so everybody has to start somewhere, especially from the background that the come up audience comes from. We know where y'all come from, man. We come from the same lineage.
Yeah.
So we all got to start somewhere. Just know that by you starting, you're going to be able to help somebody else start. So the sooner that you get this together and you able to understand this and explain it, the sooner you can help somebody else start that same, path. And that's how we all win together. Because we're not here to take money from y'all. We're not here to rob y'all. We're not here to confuse y'all, scam y'all. None of that. We're here to help y'all so y'all could help others. And that's what's going to take us there. Not the talking, not the standing on the corners, not none of that. Really doing the work on something that is free to do. Investing is free. You might pay some commissions, you might take some losses, but it's a free way to really generate real wealth. So we just want y'all to pay attention and really put the work in. Like when he asked that question, did y'all actually go back and do the 10 Qs? It should have been more yeses in the chat. It was at least 200 people in here. I think it was like 3 yeses. We got to get more yeses. If we're going to put this content out, we really need y'all to put the work in. That's it. That's all you got to do. Show up, go home, put the work in. That's it. You feel me? But I don't want to hold y'all too long. It's past the hour. We're going to get up out of here. Make sure you have some balance in your life. Everything ain't about stocks and options. Take care of your family. Call your mamas every now and then. And, y'all be good, man.
Yes. Peace and love, family.
Peace and love.